I have received quite a lot of messages through WhatsApp and a few emails regarding the withholding tax certificate that majority of us have received from the taxman with regard to the coupons that we are getting paid via the FXD investments. Any receipt of information from the taxman elicits some fear from the investor, and especially those who have not been paying taxes for one reason or another. And as we shall continue, we'll be looking at what a withholding tax is and the documentation that is required, how you're supposed to treat that document that has been already communicated to you as the withholding tax certificate, and whether the disclosure is important when you are accounting for your other taxes, and probably how you need to account for it when you are filing your tax return. We shall do that after 3 seconds short break, so don't go away. But in the meantime, as always, if you are new to this channel, give us a like to this video and don't forget to subscribe to the channel and hit the notification button so that when we upload the next video, YouTube will send you a notification. Like this video, let's engage in the comment section and see you after 3 seconds, a short break. Welcome back, and the first thing that we will look at is what a withholding tax is. And a withholding tax, which we also call a retention tax, is a portion of the tax payable by an income earner or a part that is withheld by the income payer. Any transaction of investment will have two persons. We'll have the person who is paying the income, and we have the person receiving the income. In normal cases, the person receiving the income is required to disclose or declare that income and pay the requisite taxes to the taxman. But in the case of a withholding tax, the income payer is required in law to withhold the amount of tax for purpose of remitting that amount to the taxman. In this case, they are given dates when that tax is supposed to be paid by the withholding agent to the taxman. The withholding tax applicable to investment in fixed coupon bonds is either a 15% or a 10% of the coupon amount, depending on the tenure or maturity period of that bond. Bonds that are maturing or bonds that mature in a period that is less than 10 years will attract a withholding tax rate of 15%. Bonds that mature in a period that is equal or more than 10 years will attract a withholding tax rate of 10%. That is very important because when it comes to disclosure of the income, you don't declare the net income or the amount after the withheld taxes. You are supposed to declare the gross amount if it is supposed to be part of your total incomes that will be subjected to the graduated scale rate for purposes of calculating your taxes payable. With respect to withholding taxes on bond investments, we classify that investment into two. There is investment by individuals and investment by corporate bodies. If you have invested as an individual, in this case you used your personal identification number or your PIN, then the withheld taxes are final. When you invest through a corporate body, you are a registered company, then the withheld taxes are not final. What does it mean for a withheld tax to be final or not final? It is final if the gross income is not to be added to your other income on separate source computation to be added together for purposes of determining your total taxable income. That income, once declared, you don't include it to the summation or the column where you are adding the other incomes, your employment income, your farming income, your adjusted business income, and the other incomes when you are determining your total amount that you are now subjecting to the graduated scale rate. 10%, 20%, 25% to 35% in determining your total income to tax. When it is not a final tax, it means that the gross income should form part of the total incomes that you are adding up to determine what is supposed to be subjected to tax. And the amount of tax that was withheld shall be credited, or you shall credit that amount in your CIT. You will treat it as a set-off. Once you get your gross tax payable, you deduct those set-offs or the amounts over taxes that were withheld by the income payers to get the net balance of tax to pay. Such taxes withheld but not final include but not limited to your pay as you earn, the amount that are deducted at payroll, your payroll, when they are computing your net pay. At the end of the year, for purposes of your filing of returns, there is a document that you're given by the HR department, the P9 form. The P9 form is a good example of a withholding tax certificate, but this one is a form. It gives you the figures that are with the taxman, and those are the figures that are expected to form part of your return in adjusting the figures that you are paying. And that is a part of the set-offs that you are crediting against your gross tax payable. A withholding tax certificate serves the same purpose. One, once you receive it, because you are receiving it through an auto-generated email, which is triggered by the paying agent. When CBK deducted that amount when determining the net coupon to wire to your settlement account, that tax certificate is what acknowledges that amount that has been withheld by the paying agent. And the purpose of this communication or the email is to serve to acknowledge that deduction and also inform you that the part of your income that was supposed to form your tax has already been recovered and remitted to KRA. The second reason or purpose for that communication is that you are being given the evidence or the support document that you shall require on declaring that income in your return. The reason why you shall not include it with the other incomes, though declared, is that withholding tax certificate to prove the source of the income and that this income, the withheld tax, is final. So even though you are disclosing the income, you are not taxing that income again. The third reason for such communication is you are getting aware as a taxpayer that the taxman is aware that you are generating incomes that are giving you the ability to invest. So if you are that kind of a guy who has been giving perpetual nil returns, the taxman is not expecting a nil return from you. The taxman is prompting you to amend your future tax return, and possibly they expect an income save for employed persons. If this is coming from for employment income where you do not have any other income generating activity, this document or the return will remain the same as a nil return. The withholding tax certificate will serve those three purposes. But in accounting or how you treat it at the time of filling in your returns, the income itself or the coupons that you have received as an individual shall not be taxed again. The tax that is paid is final. And that means that you are not adding that gross income to your other incomes to get the total that you are going to tax. You will declare it, need be, but you don't add it up to the other incomes. For corporate bodies, that tax withheld is not final tax, which means that you shall add the gross coupon to the other incomes, adjust them appropriately, then calculate the amount of tax that you're supposed to pay. But once you have gotten the gross tax liability, you shall deduct the taxes that have been withheld to get the net tax to pay. It is also important to take a note that at the point of investing, when you are bidding for these instruments or for these investments, at some point you declare the source of that income. Remember, these systems are interconnected in a way, and the information relating to the source of those incomes are already known as per your information that you provided at the time of bidding. And therefore, it's important. Once you have disclosed that kind of information, don't contradict what you are putting in your returns and what you programmed at the time of bidding for the instrument. Otherwise, you'll be putting yourself into a lot of trouble with the taxman. But lastly, the bottom line is that individual investors, the taxes that are withheld by CBK on investment in treasury bonds are final taxes. The disclosure will happen at the point of filing your return, but that amount of income from coupons is not added to the other incomes for purposes of calculating your tax liability. Thank you for watching and see you in the next video.